The current live trading price for NVIDIA Corporation, NVDA, sits at $182.36, trading down $2.60 or 1.41% in today's intraday session. Seeing red on the screen often triggers an immediate emotional reflex to sell, or at least to worry. But if you were watching the ticker tape bleed this morning and thinking this is a signal to retreat, you might be missing the forest for the trees. The market expectation right now is one of caution. Traders are pricing in geopolitical friction and the fear that the artificial intelligence ceiling has been hit. They see a 1% drop and think correction. But the reality is significantly more complex and, frankly, far more interesting. What you are witnessing isn't a retreat, it is a recalibration of capital before the next massive liquidity injection into the sector. The general consensus is that NVIDIA is bound by the laws of gravity, but the data pouring out of the supply chain suggests they are currently building the engine that defies those laws. Most retail investors logging into their Robinhood app this morning are seeing the red percentages and assuming the momentum is fading. They read headlines about export controls and assume the door to China is closed. However, the deeper reality, the one getting discussed in the hushed conference rooms of Fidelity Wealth Management offices rather than on Reddit forums, is that the door isn't closed. It has just been fitted with a very expensive toll booth. The recent news regarding the administration's approval of H200 chip sales to China, strictly contingent on a 25% revenue-sharing model with the U.S. government, completely upends the bearish narrative of lost markets. You might look at a 25% tax and see lost margin. Institutional investors using Interactive Brokers stock trading platforms to execute massive block orders see something else entirely. They see certainty. For the last 2 years, the China question was a binary risk, either zero revenue or full revenue, with the constant threat of a total ban. Now that binary risk has been converted into a calculated cost of doing business. A 25% tax to access one of the world's largest data center markets is a price Jensen Huang is likely willing to pay, and it is a price the market has not yet fully priced in. While the price action today is choppy, hovering around that $182 mark, the volume tells a story of accumulation. You can see the divergence clearly if you look at the flow data. Smaller lots, typical of individual brokerage accounts or those using SoFi Active Investing, are net sellers today, reacting to the headline noise. Meanwhile, larger block trades, the kind executed by pension funds and quant desks, are soaking up that liquidity. This is the classic transfer of wealth from the impatient to the strategic. When you analyze the flow of funds through major custodians like Schwab Intelligent Portfolios or Fidelity Mutual Funds, the allocation to semiconductors is not shrinking, it is concentrating. They are trimming exposure to peripheral players and doubling down on the infrastructure backbone. NVIDIA is no longer just a chip stock, it is becoming the sovereign debt of the AI economy. Let's talk about why the stock is down today specifically. It is not just NVIDIA. The entire semiconductor sector is taking a breather. You are seeing weakness across the board from AMD to Broadcom, driven by a slight tick-up in bond yields and a rotation into defensive sectors. This is macro-level noise, not company-specific deterioration. In fact, if you look at the recent earnings data, the disconnect between price and performance is widening. NVIDIA's recent report showed data center revenue growing at a pace that is almost mathematically impossible for a company of this size, up 62% year over year. We are talking about $57 billion in a single quarter. To put that in perspective, NVIDIA now generates more revenue in a month than many S&P 500 companies generate in a decade. The market is struggling to comprehend this scale, leading to these days where the stock drifts lower simply because algorithms are programmed to sell volatility. The narrative you need to internalize is the transition from training to inference. For the last year, the bull case for NVIDIA stock was built on the idea that companies need to buy H100s and Blackwell chips to train their models. That phase is still in full swing. However, the next phase, the inference phase, where these models actually run and interact with users, is where the recurring revenue kicks in. This is where the comparison to Tesla stock becomes relevant. Tesla bulls often argue that the value isn't in the car, but in the full self-driving software margin. Similarly, NVIDIA's value proposition is shifting from just selling the hardware to owning the entire computing stack. The Blackwell architecture is not just a faster chip, it is a platform that locks customers into the NVIDIA ecosystem. Once a data center is built on NVLink and CUDA, the switching costs become astronomical. You don't just switch to a competitor, you would have to rebuild your entire infrastructure from the ground up. Speaking of infrastructure, we need to address the Blackwell delay rumors that plagued the stock a few months ago. The reality, as confirmed by supply chain checks, is that production is not only on track, but is ramping faster than anticipated. The yield issues that some analysts were worried about regarding the packaging technology have largely been solved. We are seeing massive pre-orders from the hyperscalers, Microsoft, Google, Meta, and Amazon. These companies have effectively entered an arms race where the only ammunition is NVIDIA Silicon. If Microsoft buys 50,000 Blackwell GPUs, Google can't afford to buy 0. They must match or exceed that capacity to remain relevant. This prisoner of dilemma is the single most powerful tailwind for any stock in history. It forces NVIDIA's customers to spend billions regardless of the immediate economic cycle, simply out of fear of obsolescence. Now, pause for a second. I want to know where you stand in this chaotic market. Comment below how many shares of NVIDIA you currently hold, or if you are waiting for a dip to $170 to enter. It is always fascinating to see where the psychological support levels are for the retail community compared to where the technical support levels sit on the chart. Getting back to the analysis, let's look at the competitive landscape. There's a lot of chatter about custom silicon. Amazon has Trainium, Google has the TPU, and Microsoft is working on Maya. The bear case for NVIDIA is that eventually these big tech giants will build their own chips and stop paying the NVIDIA tax. It sounds logical on paper. If you are spending $20 billion a year on chips, why not build your own? The problem with that logic is the software. NVIDIA has spent 20 years building CUDA, the software layer that allows developers to actually use these chips. All the AI researchers, all the students, all the startups, they all learn on NVIDIA hardware. They code in CUDA. For a company like Google to switch fully to their own chips, they have to retrain an entire generation of engineers. It's the same reason why Windows remained dominant for so long in the enterprise space. Friction is a powerful moat. While custom silicon will take some market share at the low end for the cutting-edge training workloads that define the future of AI, NVIDIA remains the only game in town. We also need to discuss the broader retail implication. Platforms like Robinhood and SoFi Invest have democratized access, but they also amplify volatility. When you have millions of investors using the Robinhood app to trade options on NVDA, it creates a gamma squeeze effect. This means that market makers, the banks that sell you those options, have to hedge their positions by buying or selling the underlying stock. This mechanical buying and selling can exaggerate moves in both directions. Today's drop of 1.4% might be exaggerated by market makers unwinding bullish call positions as the stock failed to break resistance at $185 earlier in the session. Understanding this plumbing of the market can give you a massive edge over someone who just looks at the PE ratio and thinks the stock is expensive. And is it expensive? That is the trillion-dollar question. Trading at a forward PE ratio in the mid-40s seems rich if you compare it to a utility company or a bank. But if you compare it to the growth rate, the valuation is actually compressing. This is the paradox of NVIDIA stock. The price has gone up, but the earnings have gone up faster, meaning the stock has arguably become cheaper on a fundamental basis over the last year. It's a concept called PEG ratio. Price to earnings growth. By that metric, NVIDIA is often trading at a discount to companies like Costco or Chipotle, which have much slower growth but higher perceived stability. The market is effectively saying it doesn't believe the growth will last. It's pricing in a cliff. But every quarter, Jensen Huang stands up and reports another beat and raise, pushing that cliff further and further into the future. Let's look at the risks, because being a blind bull is the fastest way to lose money. The biggest risk to NVIDIA right now is not AMD, it is the global energy grid. These data centers are power-hungry beasts. We are reaching a point where there simply isn't enough electricity in certain regions to power the clusters that companies want to build. This is why you are seeing tech giants sign deals with nuclear power plants. If the physical infrastructure of the power grid cannot keep up with the pace of AI scaling, NVIDIA's sales could hit a bottleneck that has nothing to do with demand for chips and everything to do with the laws of physics. However, even here, NVIDIA is innovating. The new Blackwell chips are significantly more energy efficient per unit of